Good morning, everyone. I'm very glad to welcome you all on behalf of Axos and DVT McLeod today for this webinar. Thank you for taking your time and joining us. Let me start by sharing why we felt it is very important to bring this webinar to our community. We at Axos closely work with a lot of business owners, accountants, financial planners, and many other professional teams across Australia, US, and UK. One thing that we constantly see is that businesses face challenges not because of lack of effort. More often, it is because of the delay in decision making and not having clarity on the available options. And most importantly, not having the right guidance at the right time. And that's exactly we felt this is very important, to bring this session to you along with Henry and Ellen from DVT McLeods. They'll be taking us through the director penalty notices and the small business restructuring options available. These are areas where timing, clarity, and the right guidance can make critical differences. The webinar today is not just to introduce you to the technical aspects of DPN and the restructuring options. The intent is to give practical clarity to business owners and advisors like you, which will help you take timely and quick decisions and thereby safeguard the interests of your businesses and your assets. So here, Henry and Ellen today are with the most sought out and rare combination of deep technical expertise and real world advisory experience. And that's why we felt it's very important to bring our community to this webinar. Thank you, Henry and Ellen, for partnering with us. We are very happy and excited to have you both here today. With that, looking forward for a great session, and over to you both.
Okay, thanks everybody, and spare your morning to hear from us. My name is Henry Kwok. I'm a registered liquidator and a partner at DVT McLeod. On my right-hand side, it's Ellen Ma. He's a registered trustee and he's also a partner within our firm. So today we just got to quickly went through some of the updates that we see in terms of the ATO collection activities, some of the importance and key aspect of the DPNs, and we'll go through some of the options in terms of the small business restructuring and what has been changed in the last couple of years, and then finally Ellen will fill in some of the gaps in relation to the lockdown DPN components and what's the options that may be available to your clients. Just a bit of disclaimer: we don't give advice. Blah, 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 etc. The agenda for today, like I said, is just the ATO collection activity, DPNs, SBR, and some of the options for lockdown DPNs. As everyone would probably seen in the recent months, or the last 6 months of the 2025, the ATO is really ramped up in terms of their debt collections activities, and it's now much faster, much harder, and much harsh in terms of their collections, yes. And they are really focusing on non-engagement clients, where you have your clients have outstanding liability with the tax office, but the client just refused to engage or refused to acknowledge or do something that the tax office want. One of the things that I guess driven the increased debt collection activities is that because the ATO debt book has increased, which is not a news, but it has now increased more than $50 billion as collectible debt. The over debt, like the total debt book owing to the tax office, is over $100 billion at this point. But out of that, only roughly about 50 billion is collectible. Before COVID, is only like half of it, which during COVID has increased substantially, and that collection activity has now more than before COVID. So I'll explain that a little bit more. So this slide is a summary of the ATO collection activities. As an accountant, you probably see a lot of preventions and help and assist stages, which is stage 1 and stage 2. As specialist accountants in the insolvency industry, we see a lot more clients with firmer actions and stronger actions. Now, when firmer actions, we believe that this is the time that your clients or as advisors should engage your clients to really talk about options. Because once they get to the stronger action, the options starting to get very limited. Now, in the last 6 months, obviously, as everyone would know and will experience, that there will be a lot of DPN has been issued, and we expect that will continue to arise in the next financial years. If not, we're probably close to about 100,000 DPN this financial years. We have seen a lot of warning application driven by the tax office. They literally have panel of lawyers, and they have increased their panels because the lawyers can't deal with those volumes anymore. So that has increased the stronger actions, and we're actually seeing that there's a lot more bankruptcy notice coming out of it as well. And one of the things that they're starting to use is the departure prohibition order, which is again, before COVID, we don't really see that ever been used. But now they're starting to use it really on a regular basis. Some of the key updates that we see, and you probably will experience that when you're dealing with the tax office as well, on behalf of your clients, is that once they hit the stronger action stages, they're not going to be able to negotiate, or they're not willing to negotiate any further into any payment plans or anything like that. In terms of fulfillment action stages, they will consider payment plan, but you probably experience that the payment plan is now shorter. They want a lot more information. They want cash flow projections. They want a lot more different stuff. The terms are more stingy and more shorter terms as well. We also have feedbacks from accountants that they now become a risk control management for the clients on behalf of the tax office, because all they do is bug the accountants or to contact the accountants, harass the accountants instead of going directly with the clients. Which is understandable, but at the same time, for accountants, a lot of times you can't do things without the client's authorization. So you pretty much got caught in the middle of as a meat in the sandwich. So we have seen that quite a lot, and we're also seeing that the director is now looking for blames on accountants for delaying advice or for non-delivery of the DPNs. Now, because DPNs, there's not negotiable, it's not a negotiable instrument. Once that expire, it become a personal liability for a director. We have seen that there is a bit interesting trend at the moment that they will go and attack the accountants for PI insurance, and obviously unless you have documented all the encounters with these directors, we send you multiple warnings and we send you multiple advice. You just elect not to follow it. It's become a bit of a trend. Not sure if it's because of ChatGPT or Copilot, but become a bit of a theme at the moment. And some of the things, like for example, the interest is not deductible anymore, so the cost of ATO liability has increased. I mean, the interest is pretty expensive on the beginning, and now it's not deductible, which is even further penalties on it. The other thing that we're also seeing is that the ATO is starting to using AI technologies to deal with a lot of collection activities. AI automation is now become a trend. Basically, that just complies the windows of directors and advisors. So it's really compressing your response time windows, and it's causing a lot of issues with your clients and accountants. Some of the things that we've been advised by the Phoenix Task Force of the ATO is that they are now fully using AI. There's a name for the AI, and from our understanding, it's probably the 14th generation or 15th generation of that AI modeling. Quite advanced. And we have seen the mind map of the of the AI capabilities, and it's a pretty scary proposition is a modeling. So they are detecting they basically advising us that there's three key elements. One is the detection of shadow directors and straw directors, like for example people that not a director somehow get financial access to the bank accounts of a certain companies, etc. They starting to piece together with those information, and they also have an early detection model, which is dealing with a lot of notices that you guys may have received on behalf of your clients. Non-lodgements, related party transfer, Phoenix indicators are the primary things. And one of the things that they want us is the facilitator models of the AI, which is detecting who's involved in what. And what we see in practice is that, like, as you probably can see, is there's systematic reminders. If you have late lodgement, perhaps within, a few weeks, you already get the reminder, or a few days, you really get a reminder. And then if you choose to ignore it and continue to ignore it, it automatically become recoveries. And we're also seeing that when we're dealing with a small business restructuring is that the AI is now being used to analyze some of the bank transactions between the related parties, and also to look at forecasting for certain businesses and things like that. And one of the prime example is that we had a client that once you bought a luxury car, which is a feedback from a lot of our accountants refer us as well. A luxury car is purchased, which led to a immediate FBT audits afterwards. And these are some of the example of the AI. I think it's going to continue to expand in these financial years, and once the AI modeling is getting more complicated and more complete with the information that's been fed into it, and that will become more useful of it. And one of the things that they tell us even is that, for example, if you leave the country on a trip, one day, the next day the AI modelings already have the data, and they're starting to data matching of your spending patterns overseas. So these are some of the capability that is get us. Obviously, it doesn't help us when we're doing small business restructuring as well. In terms of director penalty notice, as everyone know, after COVID, pretty much all the GST income tax, except for income tax, but GST, FBT, wine tax, and luxury car tax is now DPNable. Just one thing is important: DPN is not a warning. It's a notice. It's a penalty notice. So once the DPN is issued, you are personally liable unless the client's actions one of the few options within the 21 days of it being issued. So it's the day of the notice is important. Once it issued, you are personally liable unless you do something. So it's not saying that, oh, well, you haven't received it, therefore I don't have to do something. That's not the case. Once it issued, it's automatically you're liable under the law, and it's unless you do something about it. Otherwise, the client's on the hook for it. So 4 options as always. One is paying in full. Payment plan doesn't actually remit the DPNs and doesn't qualify for the first, unless you pay it as a lump sum in the beginning, or the clients pay a lump sum in the beginning. And enter into a voluntary administration, which may lead to a deal of company arrangement or wind up, or go straight to wind up, or enter into a small business restructuring, which will lead to a restructuring plan potentially. So you will hear a lot when you're dealing with DPNs. There's something called lockdown and non-lockdown components. Basically, a non-lockdown component is that you lodge or the clients lodge the tax return, the BAS return on time, and within a 3 months after each quarter. If it's a monthly BAS, there's a different timetable for that. We're happy to provide you with an entire schedule if that's required. SGC also or the superannuation is also based on the lodgement time, but basically after the day of the lodgement, it's automatically become lockdown, and failing to lodge within a certain time is also become a lockdown DPN. So it's really important to understand that once a lockdown DPN is issued, the options for a lockdown DPN is limited as compared to non-lockdown DPNs. And we'll show you some example what that means in a second. But it's very important to understand what's lockdown and what's lockdown. To do a timeline, you have a reporting quarter of March. Ordinarily, the due date for the lodgement is 28th of April, whatever the financial year is, not the accountant due date, right? So the account. Sorry, my apologies for this. That's really bad for me. It's the accountant, sorry, it's not the accountant's due date, it's actually the company due date. So the company due date is the 20th of April. We understand that the accountant has extension. However, the DPN regime is based on the company lockdown, so company due date, so which is the 28th of April. Now, 3 months after that day, it's automatically become liable. It doesn't matter if you lodge it for even $1. Okay, if you lodge it the day before, you still have options. Now, this table it's probably important just to understand what that means. Some of the key consideration, and we'll go through some of the examples shortly, but some of the key consideration for new director is that you got 30 days grace period. Now, what that 30 days will give you is that the director will need to consider putting the companies into any form of external administration within that 30 days in order to avoid the personal liability. What I mean is that it's the same. So you become a director, effectively you inherit the tax liability of the companies, which is particularly we see a lot when you're purchasing a business and the business owners, during the due diligence phases didn't disclose that there's a ATO liability. You walk in there, 30 days later, you automatically become liable for the previous director's mistakes, right? So by resigning within that 30 days, you can't. It's actually don't remit you from that liability unless you put the companies into external administrations. One of the key things of a DPN is the delivery of it. A lot of times, if you don't update your ASIC record or update the ASIC register office, that's where the DPN delivered. And we also seen that sometimes the DPN is delivered to the company's tax agents. And also some of them is on the portal. And interesting to say that there's sometimes that if you regularly check the client's portal, sometimes they actually appears a day or two before the DPN is being issued. So it's a way to know that your client is getting a DPN without actually getting the DPN.
Just want to touch base on the new directors part. Henry touched on it's quite common. The other common issues is where you get family members, so husband or parents to children. So just to be mindful of that.
Yeah. So basically, when the kids come in or when the wife come in, it doesn't really we meet the liability of the exiting director. So the exiting director that resigned is still liable up until the day that he resigned. Is still can issue a DPN on it as well. Now, DPN can have both. That's multiple form of DPNs, which I'll show you now. So this is a very simple non-knockdown DPN. As you can see on the right-hand side, there is 4 options that is available. This one is a bit old, it's 2024, but the format hasn't changed that much. But basically, we'll outline each quarter. Now, one thing is important to understand is that they're not necessarily issuing all the quarter in each DPN. So which means the DPN that they hasn't issued the quarters that they haven't issued a DPN, it can be issued in the future as well. So basically, 2 years later, I can issue a DPN for a different quarter. So DPN is based on the quarter. Okay, so this is a non-lockdown DPN, and this is an example of a part lockdown DPN. So it's starting to get complicated, but basically what I mean is that you will see there's 5 columns. Basically, column 4 is it's non-lockdown, which means you can do something about it, and column 5 is a lockdown DPN, which means you can't do anything about it. Doesn't matter if you put the companies in external administration, the clients will still be liable for that. Now, the only difference is that when you're doing restructuring, you're offering a certain compositions of the liabilities. That liability is parallel between the two, like between the whole lump sum. So both lockdown and non-lockdown component will need to be paid. Let's say whatever the percentage is. However, the remaining percentage of the knockdown component, so for example, if the return to creditors is 30 cents in a dollar, the 70 cents of the lockdown components is still continue to be liable by the person that it's received the DPN. And that's where Alan's options need to come in to consider and in the future as well. So now this is an example of a completely locked down DPNs, which means that there's nothing you can do about it. The whole amount is due and payable. The only time you can remit it is by paying it. Now when we advising your clients, or when we're assisting you to advising your client, is that we actually look at how much is actually the long lockdown or the lockdown components, because we have cases where 95% of the debt is locked down DPNs, which means there's nothing you can do about it in terms of that 95% of the liabilities. And it's not really commercial to deal with the 5% liability by any sort of external administration. In that case, we recommend to actually seek advice directly from the personal insolvency team because they can manage that liabilities on the personal front and sort it out in terms of the lockdown DPN. One thing about lockdown DPN, once it locked down, it appears in the taxpayers portal. Now, I mean, this is his domain, but once the person deceased, that liability, unless you resolve it before he deceased, that liabilities continue to arise and or to continue to increase because the tax components, and it will sit there. And it's become what a deceased estate with liabilities, right?
And it becomes an insolvent deceased estate. And that's something I can touch on
a bit later,
at the end. But yes.
Okay, so options for DPNs primarily that we deal with is obviously there's 4 options for any DPNs as usual. But for the knockdown components, you can pay the debt in full. Payment plan doesn't help, like I said, because the moment that the DPN expire, the whole liability will crystallize and it will be parallelly sitting between the company's portal and the director's personal portals. Now, in that case, obviously, $1 reduced from the company, $1 reduced from the director's side, which is parallel. Okay, you can option for a voluntary administration, which we normally reserve for larger business, with complicated business arrangements or business activities. We can lead to a deed of company arrangement, which is a form of compromise with the tax office. Usually offer a certain sense in return to the tax office or creditors, but obviously it's a lot more complex process. The cost is usually higher. Liquidations, obviously, the end of a business operations and on the companies, and usually will resolve the lockdown DPNs immediately. Small business restructuring, which is what we're here for today, usually it's a simplified version of a voluntary administration process. One thing that we would like to highlight in the small business restructuring is that we don't run the business as normally under the voluntary administration regimes, that we go in there, take over the business, try to sell it, try to rescue it, etc., which none of those we would do in small business restructuring, hence the cost is lower. You still have to offer a certain return, but because of the cost of running the administration is lower, the tax office generally expect a higher return from that restructuring plan. We'll go through some of the changes in the recent month as well. It's not as simple as previously is. It does change quite a bit since the inceptions of that. And then Alan will touch on a bit on how to deal with a lockdown component. So, for example, if 95% are lockdown, then there's no point to even considering a restructuring options because it might not be commercial to do. So, it's something that we'll advise you and your clients at the time. What's the best options? What's the most commercial outcomes for the clients? And then clients can make their own decision on that. Small business restructurings, if you haven't touched on it previously, but basically is a COVID-19 measurement that was put up by the government. Unfortunately, they put it up within a short period of time. So there's a lot of legislative red tapes in the regimes. So there's a lot of things that no one can actually change it. Like even the form itself, only ASIC can change it. The form it's ASIC template. The regime is actually more regulation than other regimes, which is quite interesting. They managed to pack a full set of law within a short period of time and with limited consultation. So anyway, I'm not here to.
It's not perfect.
Not perfect.
But it's what we have to deal with.
Correct. So one thing when we assessing whether or not a client or potential clients may be eligible for SBR is that they have to meet this eligibility criteria. Quite simple. Total liability has to be under $1 million, which doesn't including employee entitlement because they have to be paid in full before the plans being put forward. So basically mean that the entitlement need to get paid once the process started. You got 20 business day to pay for that liability. So for example, if the super hasn't been paid before the regime started or before the restructuring started, don't need to panic. You got 20 business days to pay for that. Or the tax lodgement has to be up to date. Again, you got 20 business days to actually brought them up to date. So you don't have to like rush in and do the tax lodgement on behalf of the clients, the day before the regime started. Sometimes it's about starting the regime first to remit the personal liabilities of the DPN rather than just wait for that requisite eligibility criteria comply before you enter it.
I think in a picture perfect world, getting all that done would be great.
Great.
But in same when time is of the essence and there's
That's
no
right.
choice, then it's more important to initiate the regime first.
Yes.
Because you've got that 20 business day window to help you bring that up to date.
Correct. So I have a case previously that the 21-day expire on Wednesday. The director received a notice by mail on the Monday. I got a call by pretty much 6 o'clock in the afternoon on the Monday, had a meeting at 7 o'clock next morning. The company's in restructuring. Obviously, nothing has been done at that point, but we have assessed the eligibility criteria. Everything is ticked. At the very least, the total liabilities comply. There's no, he hasn't entered into anything within the 7 years. Take tax lodgement reasonably up to date, but the last 2 quarters hasn't been lodged. Still fine. We can get that resolved. Again, employee liability hasn't been paid, but again, still can be resolved. But most important is to put that in by Tuesday to avoid the personal liability on Wednesday. So some of these stuff, it's pretty time sensitive and critical. As at the intro stages, that time is of essence when you receive a DPN. These are some of the stages that we just summarizing here. We're not, we don't need to go through the detail. There's a lot of information online.
We'll provide a copy of this.
Yeah, we provide a copy of that so you can have a bit of understanding of the layouts. Essentially, the accountants will get involved pretty much on the pre-appointment and stage 1, because that's where a lot of work getting done. Once the plan is issued, which is stage 2 and stage 3, so stage 2, then there's not much work need to be done. It's mainly for us to deal with the tax office and to creditors to resolve their inquiries and access to informations, etc. But obviously the accountants will kick in again once the plan has been accepted, because there's a whole heaps of things need to be done afterward. It's just getting very complicated afterward with the different CAC numbers and bench numbers, etc. So who are the clients that we think is more suitable? Some of the things that we, as a tool for anyone that with a liability, less than $1 million, obviously, got a DPN or being pursued by a creditor. Got a winding up application, which is quite funny enough that is, traditionally when you receive a winding up application, the only way to rescue the business is through a voluntary administration process, which itself is very expensive and involve us as a practitioner to go into court and explain why it's in the best interest of creditor to accept any proposal. Small business restructuring is the same, but instead of us going to court, the company, which is the clients, will have to engage a solicitor to go on behalf of the company, but it saves a lot of cost because we don't have to get involved with the documentations and the whole legal process. Some of the things that we actually see quite a lot is that when the tax office reporting the clients to the tax bureau, because everyone these days subscribe to some sort of creditor watch. The moment that the suppliers get notified that, hey, your client has a tax debt of over $100,000 or whatever the amount is, the supply sees, and they went into trouble and they have to deal with it. So we're seeing quite a bit of those as well coming through, which is it's not done before.
Yeah, so there's a change in the landscape. Creditors, especially the major suppliers, moving on with the times, and a lot of them have these alerts which help them manage their business risk. So that's one of the key components.
So one of the we also subscribe to their services, obviously. And one of the things that they do is that when a new client on board, they will do a search, and that credit search is pretty comprehensive. It's cost very little. And at the same time, for the next 12 months, there's an alert being put on the client or being put on your client as a customers of theirs. That way, if there's any changes or status or any default notice being issued, they get an alert straight away, pretty much instantly, if not the next day. And they will put that clients on stop supplies or whatever the case may be. So it's just be mindful that because of the technology has increased and advanced so much these days, it's become very easy to monitoring the client's movements or the customer's movement these days. So why SBR in comparison to what's the difference between SBR and other type of administration, in particular voluntary administration, which have very similar foundations, is that main differences again is that because the directors actually still control the business, hence the cost is lower. You can continue to trade as normal. We don't have to frozen the bank account, and the cost is fixed. So that's why it's become very popular in the last 2 or 3 years. Less popular now because of the tax office, which we'll get to that, increasing their approval rates. Yeah, their approval rates decreasing their approval rates on the SBR's regime as a whole. So, which we'll get to that in a second. So we talk about a lot of restructuring plans. So what actually can be offered in there? So, I mean, there's a lot of process that I provided previously in terms of different stages, but most importantly is that the company need to offer something, right? So what is actually in there? Now, when I say that the template it's driven by ASIC, there is still options in there. So you can including any realization of company asset or third party asset. A vintage car of the director can be put on as a options. We have that before, and it was successfully sold and pay off the plan. Director personal funds can be put in as well. Lump sum payment from third party or the companies, usually third party, and preferably from the directors, so that you can eliminating some of the director loans. And it can be from trading profit. However, they're getting very difficult these days because the tax office, like I said, using AI starting to analyzing the cash flow projections to to test whether or not the company can survive afterward, and also comparison to the industry benchmark and all other cash flow that they receive from a similar industry from other restructuring plans as well. So that data is getting bigger and is harder to get the cash flow projections to be approved by the tax office. So recently we have received a lot of rejections, or we have some rejections basically saying that, hey, your cash flow projections is either unrealistic or that they have concern that the company cannot survive in a longer term. So and some of the in some industry, in particularly restaurant industries, etc., they are very pedantic about it, I'll say.
I think what the ATO stance is, with an SBR, you can do a restructuring plan up to a maximum of 3 years, but anything beyond 12 months, maximum 18 months, ATO gets very nervous because no one can actually forecast no one has a crystal ball to see what's in the future.
In particular, the restaurant business.
Food and beverages,
like
because you look at the climate out there at the moment, there are some rare occasions where some businesses are doing very well, but overall, most of those businesses have a bit of challenges and with rising costs in terms of labor, supplies, and all that sort of thing. That's why ATO, it's sort of tightening up their stance in terms of what they look at the forecast. That's why the good thing is the SBR plan gives you a whole variety of options. You can do, as Henry said, from trading profit, or you can do lump sum from company funds or personal funds or sale of assets. It's a whole variety of things. And it's a case-by-case scenario with each and every one of your clients. So once we understand a bit more information on that, we can provide a better synopsis of the options there.
Exactly. Yeah. All right. So we mentioned previously that in the pre-appointment stages and stage 1, the accountant's role is very important. And you guys need to assist the company and also us in terms of dealing with a lot of groundwork. In particularly, one of the things that we can't do is actually that by you registering us as an authorized contact directly on the company's tax portal, will save about a week or 2 for us to try to submit a form with the tax office and get them to update that records on the system. So you can do that within 10 minutes. If just the company and us, it will take about 2 weeks, if not more. So that itself is a very important role for the accountants, and it's something that your clients need to appreciate, that, hey, the accountants need to be there to assist the whole process. So a lot of things as well, like tax lodgements, unlike any other kind of external administration, you are still remain as the tax agent, and any of the accounts, once we get appointed, the existing agent will automatically get booked. Unlike that, SBR don't do that. The tax agents still remain on file. And also we need a lot of, like, for example, cash flow projections, books and records. There will be a lot of questions that we need to ask in terms of the balance sheets. Like, for example, if there's a director loan, we need to understand what it's all about. If there's an asset, we need to understand what sort of recoverability of that. And I'll explain a little bit later, because those are prerequisite information that the tax office require. Without it, they don't even got to consider the plans.
Yeah. So I just want to elaborate on that. As an accountant, you guys play a very key and intrinsic role in this SBR process. And you play a very invaluable role. So we need both the clients and us as practitioner. We need your assistance in this whole process. Otherwise, it's going to be a very challenging uphill battle to get anything.
Correct. Yeah. So these days, I think when we look at the clients or potential clients, unless we see there's a satisfaction level of books and records, we actually tell them maybe not a good option for you for SBR, because without these records, there's no way the tax office will approve these plans, or unlikely to approve these plans. So the updated request or document request from the tax office is currently on the screen. So basically the last 3 years financial and the latest management accounts up to the day of our appointment. All the assets, what they are, we need to, like I said, we do a report to all the creditors, and that need to be included with how we assessing the recoverability of each type of asset on the balance sheet. And hence we need depreciation schedule, etc., from the accountants as well. So one of the interesting things is that they now requesting R&D records, and they want a confirmation whether or not any R&D claim will be made for their financial years. Can tell you the backstory, but that's just not
a different day.
Yeah, that's the different day because apparently someone make a SPR and then make a lodge a huge R&D claim afterwards. So and one of the things that we do is the hypothetical situations or for comparison between the restructuring and the liquidation. So that's something that we do, but we just need the data from you so that we can fill it in. If it's a loan, which is very important, we're gonna need the transaction history for those. Again, if it's a future profit, then they need to be cash flow. If it's a lump sum payments, then I need a screenshot of where the money coming from.
Yeah. Can I just add to that for a moment? SPR is for all creditors of the company.
Correct.
And the only reason why we're touching on what ATO's requirements are is it's technically outside of the scope of the legislation, but this is what ATO requires for them to even consider the proposal. And with ATO being the largest creditor across the board, it's at least 99% of all matters. Without ATO's, I guess, if ATO is not in a position to make an informed decision, then there's no point.
Yep.
So
that's right. And we'll go through what the changes recently with the ATO responses as well. But traditionally, the tax office has a certain way of dealing with this matter. You can communicate with them, and you can get a bit of a discussion going on. But these days they're not anymore. Everything is done through the portal. So if unless very difficult matters or strange matter become a operator, but even then you won't be able to get the name of the operator or the decision maker unless they contact you. So it's very different than previously, that we can just pick up the phone and speak to our contact and say, hey, what's going on, and what do you think about this? I mean, we can still send a plan, but we may not necessarily get any response out of it anymore. Now we're also seeing that it's a last minute voting. They basically give it to you maybe the day before or 5 o'clock on the day. And it's really become a bit of a trend at the moment. And also the expected rate has increased. We now estimating or we're looking at least if you can afford at least 25% up. Otherwise, it's reduced the likelihood of acceptance. If there is a director loans or intercompany loans, or if your client's compliance history is very bad, the chances of rejection has increased substantially. I think the current rate is about 70 to 70% acceptance rate. It depends on whether or not you take the criteria. Now, one of the things that I think might share some aspect of the changes is that at the beginning, when the volumes of these cases are manageable by the tax office, there was a specialized team dealing with that, and there's about 4 or 5 people in that particular team, and we deal with them on a daily basis at a time. But that changed and is now become the general debt collection team managing it. So basically mean that it's become a playbook. So everyone has a bit of a rule books, and you go through it, write the recommendations, and off you go. So it's following a script. And it's no longer assessing the actual cases, because previously, they were actually analyzing the case on its own merit. But now these days it's very systematic. Okay, so some of the things that affect the ATO holdings, which is some of the things that they're giving us. Compliance, which is very important. So the tax obligation compliance, how you're dealing with the tax office historically, or you and your clients, are you responding to their phone calls? Have you responded to their letters? Have you been compliance to them? Then it does help with the tax compliant history. Related party loan, for example, DIF 7A or just director loan in on its own. And if there's any reclassification of that loan before or immediately after the appointment. And that usually is a big red flag for the tax office because again, they have access to data, right? Like I said, they have access to a lot of data. And one of the things that they have access to is your historical tax return, which usually have some information in there. With the AI systems being used, a lot of information can start to get comparative. If you're starting to reclassify a lot of information at that, after or before the SBR appointment, they will get picked up quite easily. And one of the things that, like I said before, is the R&D. They starting to look at that pretty rigidly, and also, they also got to look at some of the lockdown DPN components as well. So, like I said, if you're on a 50%, lockdown and non-lockdown, they might say, oh well, no, because you're already 50% lockdown, and what's your purpose of compromising? And one of the things that they definitely is got to reject on principle is that you're trying to get them to offer them to settle on DPNs. SBR is not for that purpose. Okay, they on principle they will reject any plans that has any, or even in the matter of fact for any deal company arrangements might involve any suggestions that to limiting their power under the DPN regime. So if you say that, hey, I'm offering you $100,000, but you can't pursue me on a DPN, they would definitely say no on principle. And if the liability, like, in a deal company arrangement, if the liability is substantial, in the millions of dollars, and you try to put that up and by pushing it through related party loans, there is a chance that the tax office may go to court and overturn the deed. Okay, so it's well and nice to say that there's all these fancy, all these fantastic things about the SBR, but what is the risk? Now, it is an insolvency appointment. Okay, so anyone telling you that's not true. It is an insolvency appointment, which means that there is a lot of things. It's going to have problems like your personal guarantee. But SBR doesn't resolve a personal guarantee. Okay, there is increasingly, especially with trade suppliers in the construction industry, is that they have personal guarantee built into their supply contract. We have seen that in some of the larger suppliers on hardwares and building materials. They have that built in as a terms in there. Now, this doesn't stop it. Okay, it does sort of compromise a certain percentage. So same with the tax office. If you offer them 20 cents or 25 cents in a dollar, they can't pursue that component, but they can still continue to pursue the other component, which is similar to a lockdown DPN in a way. Yeah. But personal guarantee again doesn't resolve that. And also the same with some of the short-term lenders loan. Again, short-term lender loans, SBR does not resolve those loans. Technically, they should, because most of them are unsecured, right? So the SBR do capture them. However, what we've seen in practice is that they either continue to deduct your bank account under the client's bank account under the direct debit facility, or they just go straight to a personal collections part of it. So that is something to be reminded of. Again, DPN, the SBR does not resolve the lockdown components. And nor it will stop the ATO to issuing a lockdown DPN. Now, once a DPN expire, it automatically become the entirety of that DPN become a lockdown. So there's no point to do a restructuring after the DPN is expired.
So on that note, time is definitely of the essence. That 21-day statutory time frame,
correct,
is super critical.
That's right. Now, one of the things is the personal credit ratings. It does get affected, but obviously there is more lenience onto a restructuring type of engagement rather than the traditional liquidations and etc. And one of the things that we put down there is unintended consequences, because the SBR regime is an insolvency appointment. a lot of contract, in particular insurance and the building industries or the builder license or for example, just us CPAs and etc. They do have a carve-out provisions for insolvency events. For example, in the building and construction industry, in particular, the home warranty insurance, if you enter into restructuring, is considered no. So the client's insurance for home warranty insurance, it's automatically cancelled. So that's something to be mindful of. When we advising the clients is that we need to understand what type of business and what's likely the unintended consequences may be.
That's on that note, sometimes your clients might be put in a difficult situation where they might be very limited in terms of their options. So it's a risk profile assessment.
Correct.
Our job here is to work with you and your clients to provide you with all the requisite information, and so you and your client can make a
informed decision. Correct.
Yeah.
Yep. Just in the next couple of slides, just a bit of a case study that we come across might suitable for some of your clients or may not be, but basically is what we in practice how we deal with the restructuring plan and the actual matter. These are all actual matter that we Ellen and myself dealt with, and in consideration of time, I'm going to move on to Ellen's part, which is the how to really deal with the lockdown DPNs, which is increasingly as a part of what the tax office really going on about.
Okay.
Ellen, just
Okay.
okay.
Yeah. Okay. Well, thank you, Henry. Yeah. Okay. So what we've focused on is bringing SBR as a regime, as an option available to your clients. Now, in the event that there's personal exposure to your clients as in their capacity as director or directors of the company, then we will look at the personal insolvency space. That's where I come in as a trustee. Now, on your screen, I'll put down a quick snapshot of bankruptcy, debt agreements, and personal insolvency agreements, or in short, PIA. Just for context, debt agreements and personal insolvency agreements are formal arrangements to avoid bankruptcy. And then bankruptcy is really the last resort option when you have no resort whatsoever. I'll just do a quick.
Sorry, just in the context of why this is important. If you going back to one of the slides that we have previously, when we're saying that the tax office on stage 4, in terms of the stronger actions, you will notice that at the bottom there's something called bankruptcy notice, creditor petitions, and departure prohibition order. These are the personal space dealings, and that's why the bankruptcy is important, because if they take that approach, which they are very likely to use that in the coming times. You need to understand, or the clients need to understand what other option is available to deal with when they receive that. Bankruptcy notice is a very serious document that once they issue, there's a very limited time window for dealing with that, and also at the same time there's very limited options available.
Yep. Just on that note, for example, company debts. So the ATO issues company, look, you've got company liability. They do through the DPN, Director's Penalty Notice, which is the conversion to personal liability. And assuming that gets ignored, so they end up winding up the company, there's still that personal exposure.
Correct.
It doesn't stop the ATO doesn't stop there. The ATO has legally rights to recover, and the next port of call is the directors. That's where it comes into the personal insolvency space.
Correct. And we have seen recently that they're doing it in sequence. So they might try to wind up the company, and then next week they will serve the director with a personal stack demand, and then after that the bankruptcy notice. So we're seeing that using as a combinations rather than individual action these days.
Yeah, that's why for us, and especially for myself, I try to promote what we call early intervention. The earlier the clients gets information and assistance and options, it gives them a lot more options to work around. If you leave it too late, then a lot of times, more often than not, there's only one option, and that option inevitably could be just bankruptcy, which we're trying to avoid. So anyway, I'll just kick in on terms of this. So, debt agreements. If to simplify it, debt agreements is like it's the personal version of SBR. Personal insolvency agreement is the personal version of the voluntary administration process. Bankruptcy is the personal version of liquidation. That's just a quick overview of that. Now, each has their own key aspect. So I'll touch on so debt agreements. You cannot propose one if your client's been bankrupt or propose a debt agreement or personal insolvency agreement within the previous 10 years. There are thresholds for assets, debts, and income. These thresholds are what we call index. It changes twice a year in March and in September. It usually goes up. At this moment in time, so you can only propose a debt agreement if your assets are less than $296,596.60. And your debts must be less than $148,000, $129.80. And your income has to be less than $111,097.35. So if you exceed any of these thresholds, then that agreement is not available. One of the key aspects with debt agreements is you can continue to operate a business, be it a sole trader or a partnership, unless the terms of the debt agreement excludes you from doing so. And the client can continue to be a director of the company, and they can travel overseas. And the maximum duration of the debt agreement is 3 years. Now, if your client doesn't fit the criteria for a debt agreement, then because of those assets, debt to income threshold, that's why they brought a personal insolvency agreement, or PIA for short. So the eligibility for a PIA is you cannot propose a PIA in the previous 6 months. There's no thresholds in terms of asset, debts, and income. You can continue to operate a business unless if the terms of the PIA includes that. And if you want to be a director of the company, you can only do so until the terms of the PIA has been complied with and satisfied with, and you can travel overseas. The duration is because the PIA it's an open arrangement in terms of you can choose whether it's a lump sum, payment plan, contributions, a whole variety of things. It's a tailored solution. Okay. But in terms of bankruptcy, which some of you may or may not know, bankruptcy has a minimum duration of 3 years. And if there's non-compliance, it can be extended up to 8 years. You cannot, there's no asset, debt, or income thresholds. In terms of operating a business, partnerships are automatically dissolved upon the bankruptcy of one or more of the partners. In terms of sole trader, yes, you can continue operating as a sole trader. But if you trade under a business name, for example, ABC Trading, then the bankrupt will need to disclose his, her, or their status as a bankrupt. You're automatically disqualified as a director of the company under 206B of the Corporations Act. You can travel overseas, but you need the trustee's written permission. But one of the options with bankruptcy is, whilst it's 3 years, there's a thing called Section 73 offer of composition. And with that it's as a proposal that gets put to creditors through the trustee to be offered to the creditors in full and final satisfaction of the liabilities. Now, if creditors vote to accept that, then the bankruptcy gets annulled on the spot. So you can come out of bankruptcy earlier. So those are some of the quick scenarios about and as we talk about, it doesn't matter whether it's a corporate regime or it's a personal regime, it's a case-by-case basis. The whole idea is we want you to be aware that there are options out there, and when you talk about bankruptcy, it's not just bankruptcy, there are other varieties. Talk about debt agreements, personal insolvency agreements. Henry touched on earlier about the cease estate. That's Part 11 administration, which I'll touch on next. But we just want you to know there's options out there. It's not doom and gloom. And the whole idea is have a conversation with us. Once we ascertain the background, then we can provide you with the information, option, and recommendations so that you and your clients can seek your own independent accounting legal advice to make an informed decision. Now, just to close off for me is the Part 11 administration, which Henry touched on earlier, is if a individual client has an existing liability with the ATO or not, and that person subsequently passes away, on the passing of the individual, it then becomes a deceased estate. And an executor or executrix gets appointed to administer the deceased estate. That executrix then needs to make an assessment of the assets and liabilities of the deceased estate. And in the rare occasion where the liabilities far exceeds the assets, then it's insolvent. And then as it's an insolvent deceased estate, then technically they can go bankrupt. But instead of calling it bankrupt, they call it a Part 11 administration.
Yep.
And with bankruptcy and Part 11s, there are two ways of going about it. You can do it voluntarily yourself, or you can do it, or the creditor, as what we talked about, ATO commencing 1-year proceedings and all that sort of thing, can do it through the court system. Now, what I want to touch on is Henry mentioned just a moment ago about bankruptcy notice. Okay, so the bankruptcy, in order for the court process for a creditor through the court process to make an individual a bankrupt, they need to go to court, and that final court hearing is called creditor's petition. But to get there, they have to follow a legal step. One of the legal steps is issuing a bankruptcy notice through AFSA, which Australian Financial Security Authority. They're the government registry. And that notice is actually similar to the DPN in that sense, but not quite identical as the creditor's statutory demand.
The DPN can be issued just to an address,
Yes.
but bankruptcy notice has to be served. So there's a key difference there. I'll just probably want to add into that is is one interesting fact before we go to question is that bankruptcy does not resolve HECS, correct?
HECS, there's two components. So it goes on to the assess component. So within bankruptcy, it's all unsecured debts are covered by your bankruptcy. There are some exceptions, court-imposed penalties and fines. What is it? Family law, when you got look, if you got to pay child support, it freezes the child support payment obligation for the duration of the bankruptcy, but it doesn't distinguish the debt. So the bankruptcy person is liable to pay for it. In terms of HECS, it depends on the assessed component. Overall, it's covered, but if there's an unassessed component, that changes. So it's a set of circumstances. And the reason why I want to touch on the bankruptcy notice is the bankruptcy notice provides the individuals with 21 strict days from the date you've been served to comply. And the compliance is A, pay the debt in full, or B, enter into an agreement that is acceptable with the creditor. Otherwise, if you fail to comply within 21 days, it's what we call an act of bankruptcy. And that act of bankruptcy is the key legal requirement for the creditor to then apply to the court for a creditor's petition. The creditor's petition is really a summons for the individual to appear in court before a judge or magistrate, or no longer magistrate, or judges, for the judge to then make a decision whether or not this person should be made bankrupt. And the reason why I'll touch on that act of bankruptcy is really critical is in a debt agreement, in a personal insolvency agreement option, if you elect to initiate that option, that process is already an act of bankruptcy. So what it means is if you do a debt agreement or personal insolvency agreement and unfortunately it fails, as in the creditor does not approve or accept it, then because of the act of bankruptcy, then any of the creditors can then
straight to the court.
Can go use that act of bankruptcy and go straight to the creditor's petition. So prior to that, there's a time frame and process to get to that stage. You've just literally
skip them.
Yeah, skip that process.
You do them a favor.
So there is a risk profile. There's a risk assessment process in all of that. And as I said, it's a case-by-case situation. And we try and find, after ascertaining the background of your clients, try and find out what is the best options available to them and what will be our recommendations and reasons for it. Yeah.
All right. So in the interest of time, just is there any questions in terms of the regimes, both for us, and then we're happy to answer. Otherwise, our contact information is there. You feel free to email us or text us or call us for any other questions. Yeah. Hand it back to the oops, sorry.
Amrutha, Nirmal.
Hey, thanks, Ellen and Henry. Thank you for taking us through all the intricacies of a DPN and the restructuring options available. So the chat box is open for a couple of minutes. If there are any questions, then Ellen and Henry would be happy to answer them.
Whilst that's going on, I just want to take the opportunity to address something that's important. Early intervention is very critical from where we stand, because the earlier that a client asks for assistance, there's more available option. And we feel that accountants especially, you guys are in a very important place because you generally have your fingers on the pulse of your client's financial situation. So either before the client even reaches out to you, you generally have an idea. And sometimes it's worth your while to even reach out. Hey, we just had a look at your last lodgements. The numbers we just got some queries. Are you okay? That's all it starts with.
I think it's also important that just a note that because of the I guess advice come from ChatGPT these days, is that you probably want to put the clients on notice that, hey, this might turn into a personal liability if you do not act. Because what we see is that we're starting to get some inquiry from our contact and say, hey, I got this letter from my client saying that this is my problems. Like, how is that going to be possible, etc. We suspect that it's probably generated from ChatGPT or whatever the Google, the AI bot that they use, but it's increasingly become a bit of a PI issues, for you as an accountant. So I would just probably in the normal dealing with your clients, add an extra sentence just as a precaution, so that they, you tick that box and say, hey, I did advise you, but you elect not to follow. That's not really my problems.
Yeah, it's sort of a disclaimer in that sort of sense, to not only help you, but also help your clients. Because a lot of times it's just bring it to getting their attention. Because look, as a trustee in bankruptcy, a very key trend of all my bankrupts is head in the sand.
And find someone to blame, right?
Yeah, no, head in the sand is, this problem's getting too difficult. You know what? I'm just going to ignore it, thinking it'll go away over time. But it never does. It just gets bigger until it's too late. So,
okay. On that note, thanks everyone.
Thank you to Nirmal and Arutha from Axos in providing us with this opportunity today to this webinar.
A pleasure. Thank you, Henry and Ellen.
No, it's just AI.
Okay.
All right. Thanks, everyone.
Thank you.
Thank you, everyone.